Mastering Throughput Accounting. Throughput accounting defies traditional cost accounting by prioritizing flow over cost control. How does throughput accounting, as a distinct approach to managerial accounting, differ from traditional cost accounting in its focus, principles, and decision-making implications, and what are its core elements that set it apart from conventional cost accounting practices? Throughput accounting, TA, is a distinct approach to managerial accounting that diverges significantly from traditional cost accounting in its focus, principles, and decision-making implications. At its core, TA is designed to maximize the flow of materials through the production system, thereby increasing the throughput of the organization. In contrast, traditional cost accounting, CA, focuses on minimizing costs and maximizing efficiency. One of the primary differences between TA and CA lies in their focus. Traditional cost accounting primarily concentrates on allocating costs to products, departments, and activities, with the goal of optimizing resource allocation and reducing costs. In contrast, TA focuses on maximizing the flow of materials through the production system, with the goal of increasing throughput and profit. This shift in focus is critical, as it recognizes that the primary constraint on a company's ability to generate profit is not the cost of production, but rather the flow of materials through the system. Another key difference between TA and CA is their underlying principles. CA is based on the principles of cost minimization, efficiency, and allocation. In contrast, TA is based on the principles of flow, velocity, and throughput. This shift in principles recognizes that the flow of materials through the production system is the primary driver of profitability, and that the goal of the organization should be to maximize this flow. The decision-making implications of TA are also distinct from those of CA. In a CA system, decisions are often made based on the allocation of costs to products and departments. In contrast, TA decisions are made based on the impact that a particular action will have on the flow of materials through the system. This means that TA decisions are more focused on the overall system, rather than individual products or departments. The core elements of throughput accounting that set it apart from conventional cost accounting practices include: 1. Focus on throughput. TA is focused on maximizing the flow of materials through the production system, rather than minimizing costs. This means that decisions are made based on their impact on throughput, rather than their impact on costs. 2. Use of throughput accounting ratios. TA uses a set of ratios, including the throughput ratio, the investment ratio, and the operating expense ratio, to evaluate the performance of the organization. These ratios provide a more comprehensive view of the organization's performance than traditional financial ratios. 3. Identification of constraints. TA recognizes that every organization has a constraint that limits its ability to produce. This constraint is often referred to as the bottleneck in the system. TA focuses on identifying and managing this constraint, in order to maximize the flow of materials through the system. 4. Use of buffer management. TA uses buffer management to manage the flow of materials through the production system. This involves creating buffers, or stocks of inventory, at key points in the system to protect against disruptions and ensure a smooth flow of materials. 5. Focus on flow. TA is focused on maximizing the flow of materials through the production system, rather than minimizing costs. This means that decisions are made based on their impact on flow, rather than their impact on costs. 6. Use of throughput-based performance metrics. TA uses throughput-based performance metrics, such as throughput per unit of time, to evaluate the performance of the organization. These metrics provide a more comprehensive view of the organization's performance than traditional financial metrics. 7. Recognition of the importance of inventory. TA recognizes that inventory plays a critical role in the production system, as it provides a buffer against disruptions and ensures a smooth flow of materials. This is in contrast to CA, which often views inventory as a drain on resources. 8. Focus on the system as a whole. TA takes a systems approach to decision-making, recognizing that the organization is a complex system with many interconnected components. This means that decisions are made based on their impact on the system as a whole, rather than individual products or departments. In conclusion, throughput accounting is a distinct approach to managerial accounting that differs significantly from traditional cost accounting in its focus, principles, and decision-making implications. By focusing on maximizing the flow of materials through the production system, TA offers a more comprehensive and effective approach to managerial accounting than CA. Its core elements, including the focus on throughput, use of throughput accounting ratios, identification of constraints, and focus on flow, set it apart from conventional cost accounting practices.